Here, David, it's great to have you. It sounds like you are willing to say there's going to be maybe some additional weakness short term, but that beginning next year, we're going to once again start to talk about the long-term potential around some of these franchises.
Exactly. We're a value shop, so we're value and dividend. We're rarely excited about technology companies. In light of the 35% decline in NASDAQ, in light of the 50 to 70% decline in a lot of companies, we are very upbeat about these companies. We think the worst is behind them. Might be some more short-term turbulence. However, if you look at a lot of these businesses, they're great businesses, and many of them are selling at 15, 16 times earnings and a few under 10 times earnings. We think it's a great time to be buying. You have to close your eyes because short-term anything can happen. But we think a year from now, a lot of stocks could be 30 to 40 to 50% higher.
I know you're watching a lot of the big guys, Amazon, Google, PayPal, Qualcomm, Apple. How does that conversation happen, even as estimates, in your view, are going to continue to come down?
Well, the estimates are coming down, but you have to put that in perspective. A lot of these companies normally sell at 30 or 40 times earnings, and today they're at 14 or 15 times earnings. Right now, the market is focused on negative momentum. We think you have an end-of-the-year flush in terms of tax selling, in terms of portfolio window dressing. But we think that people are going to look beyond a weak 2023 toward 2024, which is a recovery, and say, hey, these companies are selling at 15 times earnings. They normally sell at 30 times earnings. Let's take Amazon, for example. They generally sell between 2 to 3.5 times sales. The average is about 2.8 times sales. Today, they're at about 1.65 times sales. So we think you're getting a lot of really good businesses, really good long-term prospects. We're less concerned about the very near term, but long-term, you're getting it at a great price. And long-term, these companies are going to come back very nicely.
But, David, it's interesting to me that they've reset in different ways. So you mentioned Alphabet. I think it's back at Q1 2021 levels. Amazon's back at Q1 2019 levels. And PayPal is way back to Q4 2017 levels. So are they at different points in their execution, in the viability of their strategies? Do investors need to be careful about seeing just that they're cheap? Are there different reasons why some of these names are cheap?
Well, there are different reasons why some of the names are cheap. However, in aggregate, the technology basket has been thrown, the baby's been thrown out with the bathwater. You want to look at the companies, you want to buy companies that have good long-term prospects. So we're still wary about the Zooms of the world that sold off, or the Pelotons of the world that sold off significantly because they were COVID stay-at-home plays. But the companies that we highlighted here all have very good long-term business prospects. We like the management of most of them by and large. We think PayPal has gotten religion in terms of cost cutting. We think they have great prospects, yet you're buying it at 15 times earnings. So we're less concerned about where the levels are back to. We're more concerned about the valuations and the prospects for the next 1 to 2 years. And we think it's a great time to be buying them if you're willing to look a year out. It's a painful time to be buying them if you're buying them today.